Today, we're diving into a specific investment strategy, one that's tied to, well, corporate transaction, specifically mergers and acquisitions. We're going to be unpacking something called merger arbitrage. And if you find this kind of stuff interesting, hit that like button and subscribe, for more. So merger arbitrage, what is it? Basically, it's a strategy where investors try to make money off the difference in price between a company's stock, the one being acquired, and the price offered for it in a pending acquisition. So the core idea is to buy shares, right? Buy shares of that company that's being acquired, but buy them at a price lower than what the acquiring company is offering, to pack. Now, when it's done right, and that's key, this strategy has the potential for some pretty attractive return. And it could do all this while like minimizing the risks you get from the usual ups and downs of the market. I mean, it's a tactic that a lot of sophisticated investors, they kind of like it because, well, there's usually a clear event on the horizon. That event, the closing of the deal, represents a defined potential profit. And there's usually a fairly predictable timeline for when that profit might actually materialize. Now, important disclaimer right off the bat, merger arbitrage, it's not a guaranteed win. It's not like risk-free money or anything. There are inherent risks when you're trying to profit from a merger or acquisition, hoping it actually goes through as planned. One key concept to really get your head around here is this thing called a takeover premium. What a bigger company, right, when they want to buy another company, they usually got to offer more than what the target company's stock is currently trading for on the market. Think of it like an incentive, right? To get those shareholders, the ones of the target company, to kind of get on board with the deal, to say, yeah, let's do this. Like if the company's stock is just kind of cruising along, trading at, let's say, $24.50 a share, that's basically what investors think it's worth right at that moment. So if somebody came along and just offered $24.50 to buy the whole shebang, those shareholders wouldn't have much reason to sell. I mean, even a little bump, like up to $25, it might not be enough to get them excited. So to make a takeover offer really tempting, really compelling, the company that's doing the acquiring will often offer a significant premium. We're talking 20%, sometimes 40%, heck, sometimes even 100% or more than what the stock's currently traded for. And this is interesting. These super high premiums, they tend to pop up more often when you've got a hostile takeover, where the target company's management, they're not exactly thrilled about being acquired. And to give you an idea of just how much of this is going on, just in 2022 alone, there were 167 announced mergers and acquisitions involving publicly traded companies right here in the U.S. All right, so let's get into the nitty-gritty. Let's see how this actually works in practice. First up, what happens when you've got a cash offer on the table? So you've got these acquisition attempts, right? And even though a buyer might offer their own stock or maybe a mix of stock and cash, most of the time they start with a pretty straightforward cash offer. Picture this. You've got a software company, right? And their stock gets traded at, let's say, $25 a share. Then you got this much bigger tech firm. They decide, hey, we want to buy that software company. So what do? They announce this offer to pay, let's say, $40 in cash for each and every share of that smaller software company's stock. Now, when you get a takeover offer like that, or even, if there's just strong rumors floating around about a potential acquisition, well, the target company's stock, it usually jumps up. And I mean significantly. So from that $25 level, it might shoot up to, I don't know, maybe $38, moving closer to that $40 offer. Now, you might think, hey, it should just hit $40 right away, but it usually doesn't. There's usually a gap, a bit of a difference there. And there are some really specific reasons for this. Like, why doesn't that stock just immediately go to the full cash offer price? Well, one big factor is risk. Like, there's the risk that the shareholders or even the board of directors of the target company, they might not vote to approve the deal. It's not a done deal until it's done. And then you've got regulatory approval. Those government bodies, they might step in and say, nope, not happening. They might decide to block the merger. And then there's the market itself. The market might just not believe that the acquiring company can actually pull this off. They're like, do they really have the money for this? And then there's always the chance that the acquiring company, they just get cold feet. They back out of the deal. And sometimes the official offer, it comes with strings attached. There might be these conditions, these requirements the target company has to meet before the takeover can actually happen. And then, well, you got to factor in the time value of money. If everybody thinks it's going to take like several months for the merger to close, investors, they build in a discount, because they're like, hey, our money's tied up until then. So because of all these potential snags, the target company's stock, it usually trades well below the stated price, that price everyone agreed on, until the whole thing is finally wrapped up. And this difference between the current trading price and the announced offer price, that's what we call the spread. And this spread, it tends to shrink as the big day, the closing date of the deal gets closer. And here's the key takeaway. This spread, this difference in price, this is exactly where the merger merger arbitrage opportunity comes in. You see, the very risks that the deal won't go through at that announced price, those risks create a discount in the market. So you get these investors who are willing to really analyze those risks, to assess them, and especially if they think that the market is overreacting, that it's overestimating the chances of the deal falling apart. They can jump in and they can try to capitalize on that discounted price. Now, it does get a little trickier, a little more complex when the takeover offer involves, well, the acquiring company's stock. When it's not just a straight cash deal. When a buyer offers stock, instead of cold hard cash, or maybe it's like a combo, a mix of stock and cash, well, then you get this extra factor to think about. Because if the stock price of that acquiring company, if it takes a dip after the offer's been announced, which happens a lot, then the real value, the implied value of their offer, it goes down too. Let me give you an example to make it clear. Say you got company XYZ, they're trading at, $80 a share. And then you got company ABC, they're trading at $40 a share. Now, ABC decided, hey, we want to buy XYZ. So they offer 2.5 shares of their own stock, ABC stock, for every share of XYZ that's out there. Now, at the time of the announcement, that offer looks like it's worth $100, right? Because you got 2.5 shares of ABC, each at $40, so that's $100. It's a nice 25% premium over XYZ's current price of $80. But here's the catch. Imagine that ABC's shareholders, they're not exactly jumping for joy about this deal. Maybe they think ABC's paying too much, or they're worried about, how the two companies will mesh together after the acquisition. So what happens? ABC's stock price, it starts to fall. Let's say it drops down to $36 a share. Well, now, that original offer of 2.5 ABC shares, it's only worth $90 to the XYZ shareholders, right? Because 2.5 times $36, that's $90. So even though that exchange ratio, that 2.5 shares for one share, even though that hasn't changed, the value of the deal has gone down. And it's important to remember all those risks we talked about before with cash offers, like, the deal not getting approved by the boards or regulators, financing falling through, the time value of money, all that stuff. It still applies to offers that involve stock. So you get this added layer of uncertainty because of the acquiring company's stock price. And because of that, stock for stock acquisition offers, well, they usually trade at a discount to their implied value after the announcement. And just like with those cash offers, that discount creates an opportunity for investors who are, well, let's say savvy, to try and profit from that spread. They'd really nail this down. Let's run through a quick example, just a hypothetical one. Imagine a tech company, right? They want to buy this smaller software company, and they're offering one of their own shares for every share of the software company. So let's say the big tech company, their stock is trading at $40, and the software company, their stock's at $25. Now, if the acquiring company, they believe that offering essentially, $40 worth of their stock for a company that's valued at $25, if they think that makes strategic sense, they might go ahead and announce this one-for-one share exchange. And as soon as that news hits the market, the software company's stock, well, it's probably going to jump up, right, towards that $40 value. But maybe it only goes to $37 initially, reflecting some of those risks we talked about. So here's where a merger arbitrageur, that's what they're called, they could step in and use a specific strategy. They could buy shares of that software company, the target company, at $37. And at the same time, they could short sell shares of the acquiring tech company at $40. And short selling, that's where you borrow shares and it'd sell them, hoping to buy them back later at a lower price and make a profit on the difference. So the idea here is that when the deal closes, for every share of the software company that they bought, they're going to get one share of that tech firm stock back, which, remember, was worth $40 when they made the trade. And because they shorted the tech firm's stock at $40, they can use the shares they get from the merger to cover their short position. And that would, in theory, net them a profit of about $3 per share, the $40 they get minus the $37 they paid. Of course, you have to subtract any transaction costs. So if everything goes according to plan, the prices of those two companies' stocks, they'll converge, they'll meet, and the arbitrageur, they make their profit. But, and this is a big but, there are definitely risks. The deal could fall apart, the acquiring company's stock price could swing wildly, things like that. But if it all goes smoothly, this tactic of owning the target and shorting the acquirer, it can be pretty profitable. Now let's talk about something that comes up a lot. Is merger arbitrage really arbitrage? Like in the truest sense of the word, true arbitrage, that's what you can make a profit without taking on any risk at all. Like a classic example would be if you found the same asset, let's say gold, and it's being sold for different prices in two different markets, like one price in London and a different price in Tokyo. An arbitrageur, they'd buy low in one market, sell high in the other, pocket the difference, minus any fees, of course, and boom, profit. No risk involved. It's just exploiting a price difference. But merger arbitrage, it's not quite like that. The profit is not risk-free. It comes from buying the target company's stock, and then you're basically enclosed to the risk, to the merger, the whole reason you made the trade, that it might not actually happen. So while the goal is to make money off that price difference, actually getting that profit depends on the deal closing, and that introduces uncertainty, and uncertainty means risk. So when we talk about true arbitrage, where there's no risk involved, well, merger arbitrage doesn't quite fit that definition. All right, so how do you actually crunch the numbers? How do you calculate the potential profit in a merger arbitrage trade? Let's break it down. First for cash deals, then for stock deals. For a cash deal, it's pretty straightforward. You take the cash price the acquirer is offering per share, and you subtract the current market price of the target company's stock. That difference, that's your potential profit per share, if and when the deal closes at the agreed-upon price. And you see, it is a percentage. You divide that potential profit by the target company's current share price. So the formula is potential profit spread equals cash offer and out minus the target company's current share price. And the percentage opportunity is the potential profit spread divided by the target company's share price. Now, a lot of merger arbitrage investors, they take it a step further. They annualize that potential profit. Like if you have a 4% spread and you think a deal will close in 3 months, well, that 4% returned over a quarter, it translates to a much higher annualized rate, over 16% if you include compounding. For stock deals, the math gets a little more complicated. First, you got to figure out the market value of the acquirer's stock. Then you multiply that price by the share exchange ratio, which is just how many shares of the acquirer's stock they're offered for each share of the target company. That gives you the implied value of the offer. And finally, you subtract the target company's current stock price from that implied value, and there you go, that's your potential profit for the merger arbitrage trade. So the formulas are potential profit spread equals the acquirer's stock price times the share exchange ratio minus the target company's current share price. And again, the percentage opportunity is that potential profit spread divided by the target company's share price. Let's do an example. Say you get company ABC, their stock's at $90 a share. They announce they're going to buy company XYZ, and they're offering a share exchange ratio of 0.5, meaning half a share of ABC for each share of XYZ. Now let's say XYZ's stock is at $43 when they announce the deal. So plug in the numbers. Potential profit spread equals $90 times 0.5 minus $43. It gives you $2 per share. And the percentage opportunity, that's $2 divided by $43, was about 4.65%. But remember, the acquirer's stock price, it could jump around, be less volatile. At that volatility, it directly affects your profit. Like if the acquiring company has some bad news, their earnings are disappointing, and their stock price tanks, well, that could completely wipe out your potential profit from the deal, and it might even drag down the target company's stock too. Okay, beyond just the basic calculations, there's some other things you got to consider when you're looking at a merger arbitrage deal. Like even though a company's being acquired, they might still pay dividends to their shareholders. Those dividends, they change the map a little bit. You got to factor them in. And if your strategy involved short selling the acquirer's stock, like in that example we talked about earlier, well, remember there are borrowing costs associated with that. And since merger arbitrage is a pretty well-known strategy, those short positions, they can get crowded, meaning lots of people are doing it, which drives up the cost of borrowing the stock. Dwight, let's bring this to life with a real-world example. The acquisition of Activision Blizzard by Microsoft. This is a big deal, kind of controversial, and in the end, pretty profitable for a lot of merger arbitrageurs. Now, Microsoft, they've got a huge presence in the gaming world, right? With Xbox and all their game publishing, they've been expanding with stuff like the Game Pass subscription. Activision Blizzard, they're a major player too. They make games like Call of Duty and World of Warcraft. So Microsoft figured, oh, Activision Blizzard, they're a good company, and their stock price is pretty reasonable. They saw it as a valuable addition to their gaming empire. So in January 2022, Microsoft made an offer. They said, we'll buy Activision Blizzard for $68.7 billion. That worked out to about $95 per share. And before this announcement, Activision stock, it was trading around $65 a share. And bam, the offer goes public in Activision stock. It comes up to about $85. Nice gain for anyone who was holding the stock before the offer. But this also created a gap, a spread of about $10 between that new market price of $85 and Microsoft's offer of $95. And that's what those merger arbitrageurs, they were trying to capture. But it wasn't going to be a quick and easy win. Antitrust regulators, both in the US and Europe, they got involved. They tried to block the deal. They said, hey, this is going to give Microsoft way too much power in the gaming industry. And then Activision Blizzard, they had some internal problems, operational issues, which made people worry about what their stock price would do if Microsoft backed out of the deal. So by November 2022, even though Microsoft was still offering $95 per share, Activision Blizzard stock, it actually dropped down to around $72. But then in July 2023, things changed. The deal cleared all the major regulatory hurdles, and boom, Activision's stock price jumped up to $90, leaving a much smaller spread, only $5 between the market price and the final closing price of $95. And from that point on, the stock price slowly crept up towards that transaction price, and in October 2023, the deal was finally done. Now, it's important to note that this whole process, from the first announcement to the closing, it took over 18 months, and there was a real chance that the regulators could have just said no and failed the whole thing. So this example, it shows you that there's potential for big profits in merger arbitrage, but there are also real risks, delays, the deal falling apart, things like that. Now, for investors who might be interested in this strategy, but they They don't want to do all the trading themselves. They're actually exchange-traded funds, ETFs, that are specifically designed to track merger arbitrage opportunities. You got the IQ Merger Arbitrage ETF, the ticker symbol is MNA, and there's the Alt Shares Merger Arbitrage ETF, ticker symbol ARP. But it's worth mentioning that these merger arbitrage ETFs, they haven't performed that well lately, and they don't have a ton of assets under management. This might be because merger arbitrage, it often requires specialized knowledge. You got to be actively trading and executing things skillfully to really do well. And that's tougher for a passive ETF to do, compared to just following a broad market index. So to sum it all up, a lot of sophisticated investors like hedge funds, they've been able to make pretty good, steady returns for merger arbitrage. It's a long-term strategy. And for investors who can really dig into those risks and who could develop a solid understanding of the merger and acquisition landscape, merger arbitrage, it can be a valuable tool to add alpha to their portfolio, and it also provides diversification, spreading out their investments. But it's crucial to remember that merger arbitrage, it's a niche strategy. It comes with what they call tail risks. Most announced deals, they do end up closing, but there are going to be some that just don't go as planned. And those failed deals, they can lead to big sudden losses. So like with any complex investment strategy, be careful, do your homework, really research any specific merger arbitrage deal before you jump in. So here's something to think about. When you look at complex financial strategies like merger arbitrage, you got to balance potential reward with inherent risk. Where do you draw the line in your own investment journey? How much uncertainty are you comfortable with? Now, what steps will you take to really learn more before you dive into these specialized areas? Thanks for listening. If you found this helpful, please hit that like button and subscribe for more deep dives. See you next time.